Hi, good morning, everyone. Welcome to this webinar. My name is Johann Els from Old Mutual Investment Group, and I'll take you through my views on what I expect in the budget. But I also use this opportunity to firstly talk about the global and SA economies, because that backdrop is important in terms of the budget assumptions. So we are going to look at that, and then some views around the budget, what we want, what we don't want. And then I cannot forego this opportunity to then briefly speak to you at the end in the third section on the medium-term outlook for South Africa. We're going to have some question time at the end, and I welcome your questions, your comments, your arguments, your disagreements. They're all welcome, because I think a debate around all these issues are very important. We'll ask a poll in that last section when we talk about the medium-term economic growth. And the slides will all be available for download in the Q&A session at the end. So without further ado, let's get into it. So this is perhaps one of the most crucial budgets, but it is also a fairly crucial year for the global and SA economies. And when we talk about the global economy and when we talk about the SA economy, when I open the newspapers and I read Economist and broker reports, there is just so much negative news and negative views around. But I think relative to what we saw in 2022, this year is going to be more calmer for markets. I don't think we're going to see those shocks that we had last year. At the beginning of last year, we had the Ukrainian war, and while that war is still ongoing, the bulk of the economic impact has worked its way through. Last year, that war caused significant increases in commodity prices, especially food and energy, that had a big impact in terms of inflation. So on top of the supply chain issues that were still around, this exacerbated the inflation problem. So a significant uprise, unexpected uprise in inflation, and thus a significant shock to markets in terms of the interest rate increases that we saw during the course of last year. And now the war is ongoing. As I say, the economic impact is waning a little bit. Inflation is admittedly still high, but inflation is going to come off quite substantially during the course of this year, globally and in South Africa as well. And then while interest rates are still high and not going to come off soon, we're not going to see that shock again of significantly higher interest rates. So relative to those shocks last year, I think this year is going to be a somewhat calmer year for markets. To some extent, we've seen some of that playing out already over the course of this year thus far. If we look at the global economy, things are looking relatively better than 4 or 5 months ago. Then virtually everybody expected recession in the USA and Euro area, and even a global recession, or at least a significant slowdown in the global economy. And while there will be a slowdown in terms of growth this year relative to last year, I think the data that we've seen recently suggests that the US and Euro area might actually avoid a recession. In the US, because the private sector is so resilient, and in the Euro area, because of the significant fall in gas prices. So all of those have helped. Better data recently coming out. And also then, while it was expected that Chinese economy would reopen after the COVID lockdowns, that came unexpectedly fast and much stronger than expected. So a strong rebound in China. So all of this means that the global economy is suddenly not looking as dismal as what we thought. And if we look at some of the data briefly, PMIs, Purchasing Managers Indices across manufacturing and services industries, you can clearly see the rebound already in the Chinese numbers, especially on the services sector as Chinese population started traveling, started going out again, and this will continue to improve over the next few months. But also, surprisingly, the manufacturing components in Euro area improving quite nicely. So across these areas, a nice, at least, stabilization and a pickup in the Chinese economy. And then inflation is the other big story. But in my mind, this is last year's story. Inflation is heading lower. It's already started coming off on the headline inflation numbers. But look at the graph on the right, the underlying trends that comes through if we look at the surprise indices. So actual inflation numbers, lower than expected. That is what that downtrend in those lines mean. So inflation surprising to the downside, and that will continue throughout this year. So inflation, last year's story. Because also the supply chain of inflation. Oil prices now negative on a year-on-year basis. International food prices almost on a balanced position relative to a year ago. And on the PMI surveys, prices have also started falling. So on the back of the Chinese reopening as well, that eases supply chains even further. So all of these main indicators that caused heavy inflation during the course of last year, rolling over and inflation heading lower this year. So the global economy, yes, lower growth in the USA and Euro area. They might avoid a recession. Even if there's a recession, then it might be pushed out towards late this year into next year, might be a shallow recession, might be a short-lived recession. But they could actually avoid it. Soft landing is suddenly the talk of the town again. Interest rates close to a peak. Maybe the Fed hikes another 25 to 50 basis points in 25 basis point increments, and the Euro area another 50. We are very close to the peaks. That also means that the dollar will likely continue to drift. Not a substantial weakening, but a drift. And that helps emerging market currencies, including the rand, of course. So global environment suddenly not looking that bad for the impact on South Africa. And if we switch over to the SA economic view, and again, lots of negative news around, and of course, South Africa is more South Africa-specific issues around policy implementation, around load shedding, impact on economic growth. But generally, South Africa is in this global down cycle being better insulated against those global impacts compared to previous global down cycles. Inflationary impact, the impact on the rand, impact on interest rates, and the current account that was in a surplus position. So more insulated compared to previous global down cycles. Now, of course, there are risks around load shedding issues, around policy implementation issues. For me, the biggest risk is the impact on confidence levels. I think that generally politics and policy should be positive for confidence, but we need to sort out the load shedding issue. I still believe that things aren't as bleak in 2023 as what people make it out to be. In the investment business, we have to sit back, try and decipher what is noise, what is not. There's lots of noise around. Unfortunately, that noise impacts on consumers' sentiment and on business sentiment, and that will impact the economy. So we need to sort that out. But generally, things are on an upward path, even if that's a slow improving path. Let's look at economic growth this year. I've got a forecast of 2% for this year. Now, immediately you will sit up and say that's relative to the Reserve Bank's forecast of 0.3%. I think that's far too pessimistic, far too low. And of course, this 2% growth is already lower than what we estimate last year's growth will be. Last year, probably 2.4%. That assumes a negative fourth quarter number. That number we will only get in March. So let's go through some of the reasons for my 2% growth forecast. Firstly, I don't think the load shedding impact is that severe. If I switch to the next slide briefly, the electricity intensity of the economy has improved significantly. In other words, what that graph on the left shows, that now relative to early 2000, excuse me, the economy uses 25% less electricity to generate the same GDP. So far more productive in the usage of electricity. And that's also borne out by the graph on the right, where the BER's manufacturing PMIs actually remain relatively resilient. So the fact that so much private generation has come online, manufacturing companies who generate their own electricity, retailers who've got solar panels on their roofs, the economy can run better with load shedding. Admittedly, level 4, 5, 6, not great for the economy, but with all the plans that government has, that the private sector has, in terms of reducing the impact of load shedding, I don't think the impact on the growth part will be as severe. Just a brief example on this. If we look at just generator imports since the third quarter of last year, significant uplift in generator imports. And if you calculate the numbers, versus the size of those generators, it's 2,200 megawatts that can be produced just off the generator imports. That makes a significant impact. It tells you another story, though, that the Eskom side has weakened significantly if so much private generation is online, but that private generation makes the economy more resilient. So less electricity intensive, that helps. All those initiatives underway. But the significant fall in inflation, and we can talk about inflation in a little bit, that helps consumers' spending ability. Significant investment in energy, the generators, the solar panels, the other plants that's coming online, the self-generation in big companies. All of that is investment in the investment cycle. That will add to GDP growth. The inventory cycle, those emptied out storerooms in retailers and wholesalers and mining stocks, that's busy being rebuilt. That has got more legs to go, and that needs production to fill those storerooms, to produce the goods, to fill the storerooms. That adds to the economy. And then the rebound in China from 3% growth last year to 5.4%, and in some forecasts even higher, around 5.7%. I've seen a 6% growth forecast. That limits further significant falls in commodity prices. That will help our net export position. I would rather not get on the slump in growth bandwagon because I've got good reasons for my 2% growth forecast. I would rather wait until this time next year and take all the arguments that you have. If we talk about inflation briefly, yes, yesterday's number was a bit of a shocker given the impact on food prices, but food prices are in peak territory. Inflation will still fall. Core inflation yesterday was unchanged. You can see some of my assumptions there. Inflation is heading lower. We've seen the evidence already. Yes, food inflation was high yesterday, but international futures prices for maize and wheat have already come off quite substantially. So on the right-hand side, the bread and cereals basket within the CPI food will start coming off as the leading indicator that weighted year-on-year growth in grain prices show. So I'm confident food inflation will start heading lower. So not great growth, but decent enough growth. Far better than some of those pessimistic forecasts out there. Inflation heading lower. In this environment, rates have peaked in South Africa. I think the Reserve Bank, the MPC, will probably go on a pause at the next meeting. That will become an extended pause and will become a permanent pause. There is a very likely chance that they will start cutting rates late this year or early next year. We'll talk about the fiscal position shortly. That has improved significantly over the last few years. But in this environment, the rand, in my mind, is more determined by global factors. Drifting weaker of the US dollar, the Fed getting close to the end of the hiking cycle, all of that will be good for the rand. I think the rand will strengthen towards the end of this year. Perhaps not significantly, but enough to show that there's more confidence in emerging markets and in South Africa in particular. So a lot of things need to work out. We will probably need to see into stage 4, 5, 6 load shedding and rather have stage 1 and 2 load shedding for the rest of the year. So that brings us to the main part of this presentation, where we will look at the budget. Now, as I say, we need to do that global and local growth introduction because that's an important part of the impact in terms of expenditure within the budget or revenue growth within the budget. And I'm aiming to leave enough time for questions at the end. So we're not going to stand still too long at most of these slides. Most important part of looking forward towards this budget next week, Wednesday, is looking towards the MTBPS of October last year. That set a good example in terms of that fiscal consolidation that we need in the SA fiscal position. So this budget will be crucially measured against what that message in October 2022 was. That was a great message that instilled a lot of confidence in terms of what foreign investors, what the markets thought of the budget. If this budget deviates substantially from that message, that will be a big negative. Now, we've seen a substantial reduction in fiscal risk recently. The budget deficit, for instance, back in October 2020 was estimated to be close to 16% of GDP. We're heading towards 4%. We're heading towards, over the medium term, below 4% budget deficit. That is a significant improvement. The debt to GDP ratio was expected to peak around 95% of GDP. Now, around 70%. That's a huge improvement as well. And the primary balance, and that's the budget balance excluding interest payments, that's probably in a surplus position as we speak this fiscal year. So there's this urgent need from the markets onto Treasury, onto government, to maintain this fiscal consolidation path, to reduce that budget deficit further, to reduce the debt profile further. That's very important. But also as part of this, we've had the global and local economic backdrop, the load shedding issue. Will there be extra spending? Will we be able, through the state of disaster, the Minister of Electricity, to reduce load shedding to lower levels for the rest of this year? And then further economic reform. And I know this is the area where most of you will want to ask more questions around economic reform, looking towards the medium-term outlook. But this is probably the most important graph to show you that debt to GDP profile. Previously expected to peak, as I said around 95% of GDP. Now, firstly, 95% of GDP wouldn't have been so bad had the economy been growing more than 3% on a sustained basis. But having grown at 1% on an annual average basis, and many years even below that, that is a big risk for debt profile so high. Fortunately, we managed to reduce that quite substantially. Last year, Treasury presented the debt to GDP profile, that yellowish line on that graph. My own view, in terms of slightly better medium-term growth expectations than what Treasury has built in, is the bottom line there. That's a great improvement in terms of the profile, and we've seen some of that being reflected in the way foreign investors look at us and in the way that ratings agencies view the SA economy. So that was great, but it's not good enough yet. Because if you look at the longer term graph, debt to GDP was below 30% back in 2007-8. That is where we need to head. And a debt to GDP profile that only shows a gradual stabilization and then a gradual easing off, not good enough. But of course, on the other hand, we don't want to hurt the economy by being too restrictive on spending and taxing too much, because that's what you need to do if you want to get the budget deficit back towards, ideally, in a surplus position, where the yellow line showed where we were in 2007, budget balance in surplus position. Ideally, that's what you want to do year after year after year if you want to quickly get the debt to GDP profile back towards 30%. So we don't want to kill the economy. So we don't want to overtax. We don't want to cut back spending too much. So it is going to be a gradual process. My point is, it's going to be a continued hard work over the next few years, several years, to make sure that we keep on heading in the right direction. So we cannot afford to slip. But Treasury has done a great job. I often get the argument that people say we keep on overspending, and yes, that's true in many areas. But at least in terms of the wage bill, that wage freeze that we had, and last year, unilateral implementation of a 3% wage increase for the public sector. Had we continued on the 2019 plan in terms of where that showed the wage bill expenditure to go, we would have seen that dotted green line. We didn't go there. That gap is 140 billion. Depending on the assumptions, could be around 150 billion rand of savings just from the wage bill. That is significant. That's not a populist government. And I can hear what you're thinking. You're thinking, yeah, but we squandered that by spending on other issues. No, some of it was used for other issues. But if we look at a similar graph for total expenditure, the saving was 130 billion. So not all of it was used for other things. So significant expenditure control. And of course, last year we had a significant tax windfall as well, which isn't going to be repeated. We'll get back to that point. So in this fiscal year, the MTBPS in October set a target for 4.9%. At the time of the February budget, 6% deficit. So we've improved significantly during the course of last year because of those tax windfalls. That helped significantly. I am thinking that the outcome will be around 4.2%. Eventually, it could even be better than 4.2%. But the one thing that we have to realize in trying to judge what Treasury is going to do, they're not going to show us all the good numbers yet. They will argue that we've still got another 3 months of this fiscal year. They cannot account, and that's prudent. I give them that. But they also want to be able to show a continued improvement in the deficit. And if they show an actual outcome of 4.2% or 4%, there's not room to keep on cutting that deficit. So if they come out with this budget, they might actually show 4.5, 4.6%, which will be an improvement on the 4.9, and then allows them for further improvement down the line. Eventually, when we see the final numbers, of course, we might see this fiscal year 4% and the next one drifting up, because that to me is the risk. So Treasury won't show all the good numbers, and that's the difficulty in trying to tell you what's going to happen. I do expect a continued improvement in this fiscal year's deficit. And here you can see the budget deficit last February was aiming for 5.8, close to 6 that I mentioned, down to 4.9. I'm expecting 4.2 and maybe even 4, but Treasury might not show that. That's my point. Treasury might show a number of 4.5, 4.6. So they can show a continued improvement from October to now. And then once we start looking ahead towards the next budget, the numbers for 23, 24, they can show continued improvement. But this is a great picture. And it's also borne out by that bottom line, the primary balance. In other words, the total balance, excluding interest payments, probably in a nice surplus position this fiscal year. And that's where you want to be. If you want to continue improving your budget, you need a primary surplus year after year after year. What's important on this slide as well is the running rate of revenues versus expenditure is very positive, and that's why I expect that continued improvement. In October, Treasury said revenues should be around 7.5%. If we look at the run rate from April to December, that's running above that. Crucially, expenditure is running below the October forecast of 7.7%. For April to December, that expenditure is only running at 3.8%. Now you can see my assumption in my Johann likely outcome column shows I think there's going to be extra spending. So that balance at least is great. And there's room for some slippage on the spending side, not towards where they were, not significant slippage, but there's room in this budget to come out with a far better number. Again, the crucial point is Treasury will not show all the good news, because then it's difficult to show a further improvement in the numbers. Just briefly on those tax revenues. Individual income tax, the run rate, April to December, is running at 8.7 versus the adjusted budget's target of 7.6. Good numbers there. Companies are still running way ahead of Treasury's adjusted forecast in October, and customs significantly better. VAT is running below the expectation, and of course the fuel levy. My point about that fuel levy, I wonder if there's not delayed payments coming through, especially when I look at the December number, that's year on year versus December 21. That's still negative. If I look at the traffic at Cape Town highways, virtually everybody's back on the roads. I think that fuel levy will drift up. So just a brief aside there. Now let's start looking forward towards the next fiscal year. The MTBPS target set 4.1%. I'm thinking that starts to become difficult because we know there's going to be extra spending. We know that revenue will not be as great as in the past year, especially on the corporate, mining corporates specifically side. So Treasury's assumptions has been fairly robust in terms of in line with the lower commodity prices that we've seen. So they haven't been too optimistic. I think the assumptions were actually in line with what the numbers are playing out to be. So we don't want significant fiscal slippage. We want the continuation of the same message. I do expect a somewhat uplift in the deficit target. That's unfortunate, but markets will accept that if there are good reasons behind it, if it doesn't deteriorate too much. For instance, spending on diesel, spending on tax relief for solar, etc. That's okay because it supports the economy and you'll get some of the extra taxes back through a better economy. So there mustn't be seen to be slipping significantly, but there will be some slippage. If we look at the revenue, first point is I don't expect any new taxes, any higher tax rates, apart from sin taxes, of course. There might not even be a full fuel levy increase. There will very likely be relief for fiscal drag, that inflation pushing you up in another target band, so they will adjust the tax brackets for inflation. So I don't think this budget will be very bad for consumers. But the revenue baseline has been lifted by higher inflation over the last 2 years, and they will still get the benefit over the medium term in terms of previous assumptions, so that helps. The other point is Treasury has been very prudent over the last few years, saying the economy cannot afford new taxes or higher tax rates. That is still the case, and I think they will stick to that. And as I said, there's maybe some tax relief of some form for self-generation or solar. It's on the expenditure side that we worry. Treasury hasn't fully adjusted the expenditure budget for salary and wage increase for the public sector. There's extra amount sitting in the contingency reserves that will help, certainly. So it's not as if there's a big number. Treasury argument has been that they don't want to preempt negotiations with the unions, but it does present some risk. Treasury will likely adjust their forecasts for economic growth also lower, perhaps not to the extent the Reserve Bank did, but to be prudent in terms of a budget, because everybody, as I say at the start, expects weaker growth due to load shedding. All the load shedding support, all the policy support, all the measures in place to reduce load shedding. My assumption behind that 2% growth is that load shedding, as I say, will be around 1 or 2% levels versus 4, 5, 6. So not too bad an impact. So there will be some expenditure around that. I think the big issue in this budget will be Eskom's debt relief. I think all these other issues on the margin, for us looking closely at the numbers, we will still want to see those things. But I think the investor focus will be on the Eskom debt relief, and we'll get to that in a minute. Just briefly on the numbers again. As I say, the presentation will be available afterwards, and you can look at these in more detail. The point I wanted to make is that there will be some slippage compared to their October 2022 MTBPS numbers for the 23-24 fiscal year. So you can see I've got higher expenditure numbers. I think their revenue numbers were conservative, and my revenue is a touch better than theirs, but there will be some slippage. Now, it comes back to my repeated point that they will not show all the improvement in the current fiscal year, so that maybe they can show a continued lower deficit down the line. I think when we sit back and look at the numbers, there's going to be some slippage because of extra spending. So accept that. If the continued path down the line is still, if that emphasis is still on fiscal consolidation, reduce the deficit over time, make sure that the debt to GDP ratio keeps on rolling over, then this won't be seen as too negative, because markets realize that you need a decent growing economy as well to support the fiscal situation. So markets want to see that continued emphasis. Markets want to see continued tight expenditure control, continued easing of the budget deficit, continued emphasis on reducing the debt to GDP ratio. Those are crucial, even if there's a little bit of slippage in 1 year. Markets do not want to see populist policies. And I know there's lots of talk out there that government is heading into election next year, that they're going to buy votes by big salary increases. I cannot see how this government, who's worked very hard to get the fiscal position under control, to get this fiscal consolidation as a policy in place, how they will slip significantly on that front. If they didn't last year, despite union action, didn't cave in. I've never in this government seen significant populist issues. The jury is out. We don't know. There's no guarantees. But let's see. Markets do not want to see basic income grant. A continuation of the COVID grant is fine, but that has already been extended to March 2024. So I don't think there's going to be significant news around that. Markets do not want to see significant tax increases. I don't think we're going to get that. And then we want to see a continuation of policy. It's been a mention every year in the budget, but the implementation side has been lagging. So markets do not want populist measures. Markets do not want significant slippage. Markets do not want tax increases. And no news on Eskom's debt would be bad news. Because before the MTBPS, they promised us news around Eskom's debt. We didn't get it. Then they promised certainty that we'll get news on Eskom's debt relief in this budget. Now I'm starting to hear rumors that they haven't talked enough with bondholders, that there might not be any definite news around the numbers, the implementation, over what period. So the detail might be lacking, and that will be a hit to their credibility in my mind. So they need to come with something that markets will at least see some detail. Now, of course, up to now, we don't know, and there's lots of different opinions around this. Will there be a once-off transfer of Eskom's debt? Will there be a big number initially and then slower numbers over some years? I'm assuming 200 billion, but implemented over 5 years. Let's say, for argument's sake, 50 billion per year. We don't know. That's one of the assumptions. I think we need strict conditionality. The minister has said this. And if you want strict conditionality, you want to be able to ask or check if Eskom has complied to the conditions before you give them another tranche of debt relief. So as I say, if there's no conditionality, if there's no news, or all debt at once, I think those will be perceived as negative by the markets. But coming back to this slide that we showed earlier, the substantial reduction in the fiscal debt ratio. Even if we add 200 billion onto my view of the debt ratio, which is the bottom line, add back the 200 billion, then that's the dotted line. That doesn't look too bad. Remember that ratings agencies have in any case always assumed Eskom's debt, the full 400 billion, as part of government debt. Now is a good time to do this. We've managed to reduce the overall debt ratio from the October 2020 path. So a good time. We'll sort out Eskom's issues to a very large extent. It's not too bad for government. Government can probably finance the debt somewhat easier, cheaper than what Eskom can. So I think it's a good thing. We'll sort out some of the issues, but will not be too bad. So I've probably said all of this. I expect this budget to be credible in terms of the fiscal consolidation. I do not expect any populist measures. I'm hoping that these more policy measures or clear indications of how they're going to implement the issues around reducing red tape lift economic growth over the medium term. I want to see Eskom debt news. So I think all of that will be there in some form. Again, I cannot see that this Minister of Finance, who's gained a lot of credibility, this Treasury, which is as strong as they ever were before the Zuma years, I cannot see how they will want to squander the goodwill they've reached through this fiscal consolidation, this significant reduction in fiscal risk that we've seen over the last few years. It will be a huge negative impact if they do. The credit ratings, I think that all of this has been good news. It's been reflected in the ratings agencies' commentary over the last while, the last few years, this improvement. We've seen that all of the ratings agencies have moved their outlook statements up. I do think it's probably too soon to see Moody's and Fitch change their outlook statements from stable to positive, which is where S&P is, too soon after the budget. I think they will want to see how the load shedding issue evolves throughout the year, what the impact on growth is. I reckon they will want to wait till after the MTBPS in October this year before they move. But I think we're on that path. The point here is ratings have bottomed. We started on a slow upward path, so that is positive. So budget done and dusted. We'll see the detail next week. Look out for my commentary after that. Medium-term outlook. There's a lot of negative news around. Despite the negative news flow, we need to sit back, look at all the stuff. Many people just focus on the negatives, and there are not a lot of weaknesses. And you each will have many to add to this list. But there are also some improvements. I think those improvements will help significantly in getting annual average growth off the 1% average it was, off that downward path to a better medium-term path. So from 1% annual average in the 5 years to 2019, I expect 2.5% over the medium term. That was 2.4 last year, 2 this year, and gradually lifting towards an annual average growth of 2.5%. Lots has happened, lots of policy measures that came through. And let's sit back a moment and think, back in July 21, when the social unrests happened on a significant scale, later that same year, November 21, when the ANC did pretty badly in the local government elections, everybody expected this government to shift policy to the left, become a lot more populist, to pacify the population, to buy votes. They didn't do that. So they not only did not move from the center to the left, in fact, they moved to the right. Significantly so. This big invitation to the private sector to participate in the economy. The energy reform, by allowing anybody who wants to, individual or company, to generate as much electricity as he or she wants. That's the most important economic reform ever in South Africa. And if you just talk about reform, it's the biggest since the changeover to a democratic society. So it's huge what they have done. And yeah, there's a lot of negatives, but we've come a long way from 4, 5, 6 years ago. This isn't a failed state. 4, 5, 6 years ago, you could have argued we were heading towards a failed state status. A lot has happened that will put us on this slight upward path. We're probably not going to get to the 4, 5, 6% sustained growth, because for that we need serious labor market deregulation. We need full-scale privatization to get the private sector running all these SOEs. So that's some way off, but we can get from 1% to 2%, to 2.5%. And that's important. That makes a big impact in terms of the fiscal sustainability. That makes a big impact on what we expect for the investment returns over the medium term. So the global economy not looking too bad. Lots of negative news around in the SA economy, but we probably need to sit back and look at the bigger picture, improved medium-term outlook, significant reduction in fiscal risk, which I hope and expect to see continuing in the budget next week. I'm stopping there, and there's some time for questions, and we can even go over our allotted 45 minutes for those of you who want to stay on and keep on chatting. I'm going to go over to a poll on the medium-term outlook. Tell me what you think of medium-term economic growth. The poll will be published soon, and we'll share those with you in a second. Let's start on implementation. There's been increasing pressure on government recently, so we absolutely need more focus on getting stuff implemented, on cutting the red tape. And there are risks, certainly on the local government side. We absolutely need to see further improvement there, and risks also on the political side, the excess strength in the presidency, taking functions away from departmental departments and ministers. So yes, little or no traction around the e-toll debt write-off. I'm not sure what has been happening there. I seem to recall that national government and the Gauteng government will be taking over the debt from at least Sunroll. But in terms of what you people in Gauteng owe Sunroll, I'm not sure. And I suppose it is a regional challenge. I don't know. I wasn't in favor of this, but that's another debate. So we'll have to see what happens on that front. Grey listing question, good question. Thank you very much for that. I'm assuming that grey listing will happen, that we will be grey listed at the end of this month. But we've done a significant amount of work around regulation, legislation, etc. I don't think the impact on the economy will be significantly bad. I don't think there's going to be a big impact because it's probably been priced in the markets. It will be similar like a ratings downgrade. Impact on markets happened before the time. And additionally, South Africa was the first emerging market that was subjected to this new set of criteria by the Financial Action Task Force. So lots of other emerging markets are going to find them in the same boat pretty soon, and we won't be the only one grey listed. So my base case is we will be grey listed, but it will likely be of a very short duration and no significant economic impact. I don't think, Sydney, that the budget will be significantly or optimistically adjusted for the elections. No. I don't think there'll be any populist measures. I don't think there'll be big wage increases or tax cuts or anything like that. I don't think Treasury will manipulate assumptions or anything for the elections. I think personally the best thing government can do to get a great share of the vote in the 24 elections is to sort out load shedding and policy implementation as quickly as possible. That'll be by far the better option. Now, of course, politicians are perhaps not always as predictable, so we don't know. There's a question on what is my view of increasing budget allocation to reduce crime, address vandalism, infrastructure, etc. I think that's good. But the problem with extra spending always is how productive is that spending? Will extra spending on police necessarily lead to an improvement, lower crime, less vandalism? I think those are longer-term issues that hinges more closely with socio-political factors like economic growth, unemployment, etc. So it's perhaps not an easy issue to solve by just spending more, policing more. Of course, a lot can be done by transforming the police service, by sorting out capacity issues, etc. But there's an underlying problem of not enough economic growth, not enough job creation, etc. I'm not seeing any further questions at the moment. Did we publish the poll? Okay, let's see. We closed the poll. Okay. So let's see. Most of you, 55%, said medium-term growth between 1% and 2%. 23% says below 1%. And there's only 20% of you that shares my view of above 2% growth. I do think that's important because let's remember, economics is the study of human behavior. We're all human. Economics isn't an exact science. So the potholes in your street, the load shedding issues, that impacts on us. And to me, that's the biggest risk. So that impacts on our spending ability. That impacts on our willingness to spend. So that impacts on economic growth. So if we can't sort out capacity issues, we can't sort out the confidence crisis, then absolutely growth isn't going to get to above 2%. But I also do think that if we sit back and take a balanced view of all the negatives, all the improvements that we have seen, we've certainly turned the corner. We've turned the corner. We're not heading downward anymore. We're starting to move up. And that's important. And I strongly believe we're heading towards 2.5% medium-term growth. That impacts on investment returns. And if the bulk of the population doesn't believe that, that creates opportunities for the rest of us, because then there's a market repricing coming. There's a surprise element coming, and that's where you make money in investments. I think that's a good time to end off this. Thank you very much for joining. The presentation is available to download. Welcome to feedback, any questions, concerns, comments, arguments back to me through whatever channel. Again, thank you for attending. Have a good budget next week, and I wish you all the best for this year, and we'll see how this pans out. It's not doom and gloom anymore. We're on an upward trajectory. Thank you very much. Have a good day. Bye-bye.